Good morning, good afternoon, or good evening, depending where you are on the planet. Welcome to the Monday, the 29th of July, Bull versus Bear webinar. Steve Mighty here on the Call for Trade Day. Welcome, everyone. We're going to go through our slight twist on the usual regular webinar for a Monday, where we look at the shape of the week to give us an idea of where the potential volatility points might come further out into the week. Why do we do that when we're day trading at trade day, right? We're day traders. So why do we need to know what's going to be happening on Tuesday, Wednesday, Thursday, Friday? Aren't we just interested in today? Well, the reason for that is because if there are potential circumstances, whether they are central bank events, macroeconomic data events, microeconomic, so earnings reports and events that are coming up at some point in the week, that might mean that there's an expectation of potential higher volatility, maybe higher, bigger probability of more trending markets during those events. And then if there is going to be more volatility at a later point in the week, then there's potentially going to be less volatility in the maybe earlier part of the week. So the market might be more in a consolidation, wait and see, pause mode, and then we'd expect price action, the market movements, to be more of a mean reversion. What is mean reversion? Well, reverting to the average. So more of in a consolidation range, wait and see mode. So that's why we go and take a look at all of this. So before we get into all of that, though, let's take a look at so we've got these. So where you're watching, if you're watching live, below where you're watching live, we have the three columns with all our research in. The left-hand column is the technical analysis column, where the daily market chart is. My market chart is reports are uploaded every day, so they're on the left hand column. We'll come to those a bit later. In the middle column, we have the fundamental macroeconomic reports that we put up on a weekly basis. We have both the macro matters, which is this more in-depth report looking both at what happened last week and going through what happened and why it happened, and then also looking at the week ahead. And then we have also in that middle column a more condensed version of this, which we call the weekly recap and update. So that's also looking ahead, but looking back, just as sort of a précis, a summary version of the macro matters. And then in the right-hand column, the third column, we have our news from Live Squawk, our partners at Live Squawk, where you can get the Live Squawk as well, which is above where you're watching the webinar. You can click through and get the Live Squawk service. On the right-hand side, you get the right-hand column is the European and the US and the Asian updates that we have on the news side every day from Live School. So let's start off. I'll just touch on these. Look at these bullet points in here, which is kind of then expanded on slightly in here. But so last week in here we experienced further rotation. That's been the order of the day now for about 2 to 3 weeks now. We've been this rotation since early July, since the market kind of topped out, since the indices started to sell off. We've seen the major tech index, the NASDAQ, sell off, and we've also seen the broader index, the S&P, be pulled down with it, as we've seen a rotation out of these mega cap growth stocks that have really powered the market on during this bull run that we've had throughout this year and coming even from last year. So this bull run has taken a breather. We've had a significant sell-off in both the NASDAQ and the S&P, but the breadth of the rally is actually widened. And what do I mean by breadth? Well, it's just that more participants, more stocks are actually doing better than they were previously, because what we've seen is a rotation into more defensive stocks, out of the growth stocks. We've seen a rotation out of cyclical stocks into those defensive stocks as well. We've seen a rotation out of the large mega caps into the mid caps and the small caps. So that rotation has meant that the actual breadth of the overall rally is actually improved. So overall, that's a signal that the market is not concerned about the actual economy. The market is more concerned a little bit about valuations, and maybe that the tech sector, that the growth sector has been, and the mega caps have been overextended, which they certainly have. They've been stretched, they've been on a tear. Nvidia, for example, up over 50% at one point, or just this year alone. So a correction of that is kind of quite normal, and maybe a rotation. Some of the other stocks, the mid cap, smaller cap stocks, playing catch up. So that was a flavor of the flavor of the day for about 2.5 weeks now, and that was accentuated through last week, when in the middle of the week we had both Tesla and Alphabet reporting. Alphabet, the parent company of Google, actually did okay with their numbers, but there was some of the guidance wasn't quite that great, and that meant Google, Alphabet / Google did sell off, and Tesla was actually fairly negative, so that sold off, and then that helped, this correction lower that we'd already seen in the mega cap stocks, the correction low that we've seen in the tech stocks was accentuated last week by these Tesla and Alphabet numbers through the middle of the week. So we certainly saw a significant sell-off again last week. Those were the first two of what we call the Magnificent Seven. So the Magnificent Seven stocks have been monikered. They are Tesla and Alphabet, and then also Microsoft, Apple, Meta, Amazon, and Nvidia are classed as these huge mega cap stocks, all from the tech stock known as the Magnificent Seven. So we've had two of those report last week. The other four of the balance of those Magnificent Seven stocks, as I just listed out there, Microsoft, Apple, Meta, and Amazon, all reporting this week, and we'll come to that shortly. And then the final one is Nvidia, arguably the most important stock on the planet, as Goldman Sachs have named it. Nvidia are reporting. They don't report for another couple of weeks. It'll be way in towards the end. It'll be the 20-something usually of the following month. So we're about 2-3 weeks into the earnings season at the end of July. So we're going to be way into the earnings season. They come towards the end of the earnings season, all the way out in it'll be out in August sometime. I'm not sure of the actual date, but we'll be waiting on watching for that further out. But we get four of the other seven Magnificent Seven, having had two last week, another four of those coming up this week. So those disappointment that sent the market certainly even lower Wednesday through Thursday, but we did get then a rebound on Friday. The core PCE data actually was disappointing on Friday. So PCE, remember, personal consumption expenditure. This is the Federal Reserve's preferred measure of inflation, and it was actually slightly warmer than expected. If we go to the daily calendar in here, I've got this on today, but if I just dupe that out and we go to last week, let me go to Friday's data in here. You can see the PCE data in here, personal consumption expenditure, actually slightly warmer on the year on year. The month on month on the core data, which is the core data we're really looking at, the core month on month came in bang in line. The core PCE year on year actually came in the same as it did last month at 2.6, when we expected it to cool slightly to 2.5. So it's slightly actually warmer than expected, which is a disappointment, and should have seen markets potentially go lower. So that's telling me the fact that we did get a rebound back on Friday says to me that that sell-off is coming to an end, because that data was fuel for the market to go still lower, and the market didn't go lower. It actually had been stabilizing through Thursday, trying to base. We spoke about this trying to base on Friday's webinar, and that continued through Friday after the data, and this data was really a green light for the market to go lower, and it didn't go lower. So I think that's quite interesting as well. So where are we going through in this? We're up to, so the PCE date slightly disappointing, and then in here, so that's talking about the data from Alphabet and Tesla, and then the other real big thing is then this week ahead. This week ahead is massive, okay, an absolutely massive week ahead. Look, a super busy week in focus. Fed, Bank of England, 4 times the Magnificent Seven earnings, PMI plus US jobs data. All of those are upcoming. And if I jump down to the end in here on the what's ahead, so we do get the Bank of Japan on Tuesday, but more importantly, the Fed on Wednesday. Now, if the Fed are not going to change rates, that's almost nailed on. If we go and take a look at the Fed Watch tool in here for July, what does it show us? Fed Watch tool for July, nearly 96% chance that rates stay at 525 to 550. That's the current target rate, 525 to 550. 525 to 550, 96% chance unchanged. But there is a very, 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 very high percent, in fact, over 100% chance, well, not over 100, actually, 100% chance of us getting a rate cut in September. So there's no chance in here over here. So 525 to 550, there's not priced in that we remain unchanged. Completely priced in, we get one rate cut, 89.6% chance, but there's an outside chance here, about a 10% chance we get not just a rate cut of 25 basis points, we get a 50 basis point rate cut. And now by the end of December, what we're starting to price in So if this second column in here is for 2 rate cuts, 32.9 plus this 1.1. So we've got 34% chance of 2 rate cuts now by the end of the year. So that means a 66% chance we get 3 rate cuts by the end of the year. So the market is certainly getting quite aggressive on what it's expecting on the rate cut side. And the reason that we're watching out for the Fed on Wednesday is we might start to get some clues now from the Fed. Now, we don't get the dot plot chart, but what we will get from the Fed is some kind of understanding of what their thoughts are, where they're looking at inflation, where they're looking at for the economy, and we'll get some kind of idea of, they should flag to us very much that there's a very, very high chance, or almost a nailed on chance, that we get the rate cut in the September meeting, but also start to get some kind of idea, is that's going to be the first of more than one. You know, the market is pricing in now pretty much that we're going to get 25, 25, 25 now through the September, November and December meetings. Don't forget, though, also this week we get the Bank of England. Now, that's kind of on the wire, whether we get a rate cut from the Bank of England, whether they kick off with their first rate cut. It's kind of, I don't think it's quite 50-50. I think it's like 40, we're sitting around 40, 60, 40%, only 40% chance of a rate cut. But there is a chance of a rate cut coming out of the Bank of England as well. That's on Thursday, so we're watching out for that. On the macro data side, what do we have? Well, the big one is going to be the US jobs report, the US employment report that we get on Friday. But ahead of that, we get global PMI data, global manufacturing PMI data. That comes out always on the first of the month, given that it's a weekday, a working day. And that's, we get that on Thursday. So the 1st of August is Thursday. We get both the global manufacturing PMI data and also the US ISM manufacturing PMI data. And then on Friday, the US employment report, always much to watch. And then don't forget, we also get 4 of those Magnificent 7 earnings this week. Microsoft Tuesday, Meta, aka Facebook, on Wednesday, and then Apple and Amazon on Thursday. All of those after the bell. Will come to those shortly. So just looking into the macro calendar, you can see nothing of note in here today. If I jump to today's calendar in here, you'll see nothing on there. We had some Australian data, absolutely nothing on there going into today. And then all of that data that I've gone through with the Bank of England, the Fed, the Bank of England, and then also that PMI data and the US employment report coming up through the week. And then there's all the highlights from the data that we have coming up this week. Microsoft, Meta, and then Apple and Amazon as we go through the week. Intel as well on Wednesday. We go to the earnings reports for today. It's not particularly big on the earnings today, with all that other stuff coming up from Tuesday through Thursday. McDonald's is already out. Disappointment from McDonald's. And then the rest of the stuff in here not really going to impact into the major indices. So the main focus in here is super busy week, Tuesday right the way through Friday, Tuesday through Friday, particularly though Wednesday through Friday, because Microsoft we get is really the first important thing we get in here. That's after the bell on Tuesday. So Monday, Tuesday, we're expecting more of a consolidation range, maybe narrower. We just looked at the calendar, right? Look, nothing there at all, right? So, and then nothing significant on the earnings now. So what we're really waiting for is Monday, Tuesday expectations of a fairly quiet consolidation. And my view is we're trying to base. I'm going to come to that shortly when we look at the charts. But I think there is a slight upside in here going into today and into tomorrow, but more of a consolidation and up. And then we're waiting on all of these different data points as we go into the week. Let's just run through some of the macro stuff. 5 things to start your day. Big week for tech. It's going to cover all the stuff we've already gone for, right? So big week for big tech in here. We already covered off that. Microsoft, Meta, Amazon all report. We've already said that. Big tech, central bank decisions in here. We've spoken about that. Bank of England, Federal Reserve, and Bank of Japan, Federal Reserve, and the Bank of England cover that. The Fed is widely expected to leave rates unchanged, hoping for a clear hint that a rate may come soon. 25 points. Priced in for September at least. We've already covered that. Bank of Japan, we have high alert when it leads on central bank course on Wednesday, so we're watching out for that on Wednesday. And Treasury Secretary General has rebuffed former President Donald Trump view that a strong dollar is hitting US manufacturers. Blah doesn't really impact what we're looking at. So stocks are slightly up in here this morning on the US futures. European equity futures doing well after Asian stocks, we'll come to that shortly, have done well on the overnights in here. And focusing on everything we've mentioned. US stock turbulence throws spotlight on big tech valuations. So big tech, really in focus. It's going to be really important. with those with Google, aka Alphabet selling off and Tesla selling off already last week. It's going to be really important how these four of the Magnificent Seven that we get coming out this week, how they perform. That's going to be really key to potentially how we perform throughout the summer on a bigger picture view on stocks. Calmer, but for how long? With markets obviously starting to rebound at the moment, it's all going to be about big tech, futures rises, Fed verdict, big tech results expected. All the same stuff in here that I've already covered that was also that we covered at the weekend in our macro matters. Fed like to hold rates steady one last time as inflation finale unfolds. And then European shares are up today, gains on the oil sector and an earnings boost as well. Let's take a look on the overnights in here, and you'll see Asian stock indices, once this reloads in here, up 2% on the Nikkei on the overnight and over a 1.25% on the Hang Seng. We jump to the European bourses and we see that again up for the most part in here. The UK FTSE up over 7/10, German DAX 3/10, but the French CAC actually down about 1/3% this morning. And on the overnights on the US futures in here, which I thought I'd pop this open, but I haven't. So let's just open up the futures on the overnight, slightly higher in here with the Asian and European exchanges pointing up. We're slightly up once this loads. Going into today. Here you go. So 7/10 up, significantly up, and 0.45, 0.4% on the S&P and Dow, respectively. Already covered the Fed Watch tool. What's interesting here is the bond yields as well. Look at bond yields this morning. This is this morning on the 10-year, back to the lows that we saw in the middle of July. Significant push to higher prices, lower yields. So that's a breakdown through those low yields. 10-year note, if we get down through 4.15% in here, we could see a significant move lower in yields. On the US treasuries, we actually flipped to slightly bearish in here on the 30-year because it looked like a topping pattern, but we flipped that back to bullish in the 10s, 5s and 2s. This was, remember, written over the weekend before we had this bullish move that we've had in treasuries already this morning as well. So these markets all looking even more bullish in here as we go into today. So bullish on the 2s, 5s and 10s, pointing higher prices, lower yields. That should be supportive of stocks, and it has been this morning. And despite us staying negative in here on the overnights in here, so when I wrote this at the weekend, because the market started to try to rebound off some support levels in here on both the Nasdaq and the S&P, but really didn't get going on Friday. But the follow through that we've seen today causes me to be more bullish. You can see in here already on the 10-year note, we're actually above the peak in here. So this is on the bond markets. The bond markets up above the higher here. 111.15 was the mid-month, and we're just above that on the US 10-year, and also 2s and 5s. I think if I go to look at 5s in here, look, so 5s as well, breaking up through the high this morning, and the same thing is to be said for the 2s in here, but I'm not going to go into all of that. But what it's saying is bond prices up, bond yields down. That's positive for stocks. Let's look at the ES. So you can see the ES already back to these two peaks in here. We've got a bottom. This is a bottoming pattern. We'll see it when we go into the 30-minute chart shortly. Back up to the peaks in here from last week, and Nasdaq not far off as well. So if I zoom in, first of all, on the ES in here, on the S&P 500, once it reloads on the 30-minute, I might have to jump to the Nasdaq while the data's filing in. Sorry, guys. This was all up here when I set this up earlier on. Here we go. So you can see in here what we've got, you could argue, is double bottom down here. That triggers through here. You can see we just failed it at Friday, just failed it on the overnights this morning, and we're right back up there. So that's a critical peak in here. You could argue this is some kind of convoluted double-headed head. Is this like a double head shoulder here? Is this a shoulder? Not really. It's more like just a straight double bottom. So, but definitely a basing pattern, no matter what you want to, how you want to look at it. So up through 55.33 and a quarter, up through there, I'd say, if it's pre-cash market open, Is it relevant? Yes. If it's post-crash market open, then it's certainly super relevant. So 55.33 and a quarter, critical trigger point in here for the ES. And as the NASDAQ lows, we've got similar in here. Again, is this a shoulder, double head, shoulder kind of pattern? No matter what it is, it doesn't really matter because the trigger point is up through the highs. You can see we've stalled in here a couple of times at this area here. So we are going to be looking at up through 19,335, really up above that interim peak, up through 390. 19,390 would be a significant bullish signal in here. And then that, the measure would be this move here. So we could see it take off today. I don't think it will take off today, but I think this is setting a base up. So we kind of get a signal for a base, a technical base in already, and it's setting us up for as we go through Tuesday night with the earnings data, and then into Wednesday, the Fed, and then we get the macro data and all that other earnings data that we have coming up from the Magnificent Seven. So I do think this is setting up a base. It could destroy the base and extend lower, right? But it's not going to destroy the base pre any of that data. If anything, the market is now poised to want to make the base, I think. So up through those trigger points, those peaks there, I think is the risk today. So that's why I said upside today, potentially further upside than we've had, but not a runaway bull like run today. More of a consolidation push higher for me is the view. All right, it's much longer than I usually run in here, but Mondays are always much longer because as we go through that shape of the week. I'm going to wish you all a great trading day. I'm going to wish you all a great trading week. We're going to hopefully have a new analyst come on and do some stuff for you. A trader friend of mine in here, Duncan will be taking some of the webinars later this week. I'll introduce you later in the week to Duncan, and we'll go from there. And he'll be covering through some of the summer, hopefully as well, whilst I am on vacation. So but I'll introduce you to Duncan later on this week. All right, guys, I'm going to wish you all a great trading day. Take care, stay safe, and I'll be back with you with another Bull versus Bear webinar tomorrow.